The cyclical trade has been going since September. If you look at charts of the market, it was September 2nd that many of the tech names peaked, and we started to have enthusiasm about vaccines and reopening. And that's when energy, financials, industrials, hotels, casinos, airlines started to move, and that move has accelerated. So we've moved into this year with big gains in the cyclicals, flat or no gains in the large tech, and really a collapse of many of the hot names of 2020 that were new issues: Airbnb, DoorDash, Snowflake, CrowdStrike, Trade Desk, Zoom, Teladoc, because those stocks were very overvalued. And then there are growth stocks in the middle and value stocks in the middle that have moved up as the market has. But as you said, it's a tale of three cities, very different kinds of markets. The question is whether the cyclicals keep going and the tech go down. And we would say right now the market multiple, the price to earnings ratio of almost all groups at the market, all sectors, are about the same. Industrials sell for about the same multiple as the tech names such as Facebook, Apple, Microsoft. They are not as expensive as they were last year because they paused or gone down now for 6 months. And we think there's value in some of those large technology names. The cyclicals and values have moved so much, so fast, they might need to take a pause. The whole market can go up this year because that's what usually happens in recovery years and strong GDP years. But there could be a rest to the cyclicals for the time being.
Tech names you're just talking about, the Facebooks, the Amazons, they've definitely been hit hard by these rising bond yields. Can the markets continue to go up if tech's not along for the ride?
That's a very good question. Technology plus communication services and Amazon, just that stock, those three categories are over 40% of the S&P. And for the market to move higher, you really need participation in them. If the market goes down, of course, they can all participate on the downside. But we think that for the market to go higher, you would have inclusion in those larger tech names. And they are earning enough to justify that. If you think about what people will use their stimulus checks for, they're going to pay rent, they're going to buy food, they're going to go on vacation, they can take a trip. They're also going to buy an iPhone, and they're going to pay for it with Venmo. So Apple and PayPal are going to benefit just the same as American Airlines and Hilton Hotels. And so yes, they will participate if the market moves higher. And as we've looked at, 11 out of the 12 times over the past 50 years where GDP has been up 4% or we've come out of a recession, you've seen the market go higher, the S&P 500 go higher. The only exception was 2000 when we had the dot-com bubble burst, and there was a recession following that, not preceding it. So it's likely that the market moves higher, and all stocks generally participate if that's the case.
So, Carrie, oil prices, they're steadying today after tumbling 7% yesterday, the worst day for WTI in 6 months. Rising COVID cases in Europe, Brazil, and India dampening hopes for a quicker global recovery in fuel demand. Oil has doubled since November, though. Is this a demand issue or just a short correction in your mind?
Well, oil prices have gone up, just skyrocketed over the last few months because of reopening. Remember, you couldn't sell a barrel of oil, 9 months ago. They were giving the oil away. The futures were negative, effectively. So to be over $60 a barrel is really much better than I suspect the producers had thought they would see for a few years. I think it's reasonable to expect after this sharp rise that we would have some decline, some air pockets. So I don't see for the industry that this is a problem. COVID cases rising, of course, that means less driving, less flying, et cetera, and that's bad for energy. But this sector should be very happy with how they performed over the last few months.
All right, Carrie, we're almost out of time. Can you give us a few stocks that you're kind of looking at or you own that kind of balance this recovery and the fact that we're still working from home in most states?
Yeah, exactly. So on the recovery reopening side, we bought American Express. Of course, they benefit from travel and also interest rates going up. Charles Schwab, it's a bank, so they get the benefit of interest rates. People spending money, people trading accounts, of course. And Booking Holdings, because Booking is where people book their trips and hotel reservations. We think that's a good play. SL Green, real estate play in Manhattan. On the other side, we own Facebook, we own PayPal, we own Visa again, and how about buying Apple? We think that's an attractive stock right here.
Shepard Smith here. Thanks for watching CNBC on YouTube.